Millennials in the United States will inherit roughly $30 trillion over the next 2 decades in what will become the biggest generational wealth transfer in American history. The impact the COVID-19 pandemic had on the economy, as well as any changes in inheritance tax rules, could end up speeding up this process. In a nutshell, this means they'll have a lot more money to spend, and that could lead to financial mismanagement. This is why it's so important to understand and implement the best financial strategies. What is the meaning of being a smart investor, and what steps do smart investors take to ensure their money works for them in the long run? Let's dive in. But before I do so, I want to welcome you to Mr. Vin TV, and if you're not subscribed, do so by clicking the subscribe button and click the bell notification icon to get all future updates. How to be a smart investor. First, let's examine the term smart investor. A smart investor isn't someone who can make a lot of money in a short period of time. Rather, it's someone who can use available resources to make a solid investment. Once they are generating income, they diversify their portfolio and accumulate wealth over time. Smart investors don't invest their money where everyone else is investing, but instead they educate themselves about the market or the type of business they want to get into. Performing extensive market research before investing is one of the traits of a smart investor. Let's look at 5 of the ways you can also become a smart investor. Number 1. Start by investing early to gain an edge in the market or the business you're looking to get into. The more you wait, the more you might find the opportunity that was once there is already lost. You should also be consistent with your investment habits, not just once every year. This is investing a specific amount of money each month or quarterly. This is the only way you can maintain your financial discipline in order to reach your financial goals. Number 2. Having a diversified portfolio should be the next thing on your mind. Making investments comes with its own set of risks, but you won't feel the pressure of these risks if you have different streams of income. I can assure you that having different investments can help you to avoid some extreme financial losses in the case of a volatile market. But remember, too much of something can be poisonous. Invest in the things you are thoroughly knowledgeable about. Number 3. A smart investor builds a risk appetite and learns to manage their risks. Every investment in itself is a risk, and you can't be an investor without taking some risks. Let me clarify one thing though. You must know the level of risk you can handle in every investment, because patience comes in when you are navigating volatile markets. This will help you to secure a financial future. Learn to be patient. Don't forget that good things come to those who wait. Make it a habit to learn something new about investing every day, and it will pay off in the long run. And although what I have just said may sound easy, you'll find that even the best investors make mistakes and end up regretting them. Even Warren Buffett made some of his own. Number 4. Stick to an investment plan. Before you spend a single penny in a company, make sure you know why you are buying or investing in it. Know what goes into the running of the day-to-day operations. Just because you like eating does not mean you should be running a restaurant. The business you choose should be because of the profits you stand to make in the long term. Don't let emotions cloud your decisions. Stick to your plan. Number 5. Be more conservative. When investing, avoid doubling down. Don't throw money at a sinking ship. Know when to cut your losses. Be cautious. Don't let past losses influence your future decisions. If an investment is failing over time, then there is a high chance no amount of money will save it. This is why the renowned billionaire Warren Buffett is known as the wealthiest investor today, with stocks in over 40 companies in the world. Warren Buffett is what you'd call a very smart investor. His investment strategy changed to acquiring stock in companies that he believed were well managed and undervalued. He tends to hold on to the stocks he buys indefinitely when he makes a purchase.
Well, if you own stocks like you'd own a farm or apartment house, you don't get a quote on those every day or every week or anything. You look at the business, and the value of American business depends on how much it delivers in cash to its owners over between now and Judgment Day, and I don't think it changes in 10% in a 2-month period if you're looking at it as a business. Now you've got anything can happen in markets. I mean, anything can happen in markets, and that's why I say don't ever borrow money against securities. That markets don't have to open tomorrow. I mean, you can have extraordinary events. So I think to some extent you can get some of the instruments that people don't understand very well that have a lot of firepower in them,
like
and
the volatility
they
index
can trigger.
and things that are
Yeah,
tied
and
to that.
the idea of people taking a position, and they're gambling. They're not investing. Nobody's investing when they buy, some supercharged index on how the VIX does or something like that. They don't need it in their life. It's an unnecessary instrument. Now, they will create instruments that the public will buy, and you can just count on that. Wall Street's been doing that since they met under the buttonwood tree in 1792 or whatever it was on the exchange. So, but if you're investing, if I'm going to buy a half interest in a McDonald's stand and you're going to run it, or a McDonald's franchise and you're going to run it, I look to the business to determine whether I made a good investment. And I'm concerned about, whether we have new competition, how we do over the years. But it's the business I look at. When you're just looking at the price of something, you're not investing. I mean, if you buy something, Bitcoin, for example, or some cryptocurrency, you're not looking to the asset itself to produce anything. If you buy an apartment house, you're looking at how the apartment house does. If you buy a farm, you're looking at the farm does. If you buy a whole business, you're looking at how the business does. If you buy a part of a business, why shouldn't you look at how the business is going to do? But people get charmed by lots of action and the fact that things are liquid and all of that. And it does have repercussions back into the market when you get something like, an ETN arrangement on the, supercharged on the VIX. I mean, where you can lose 90% of your money in one day. I mean, that really doesn't belong with the word investment. You can buy small pieces of businesses for less than you can buy whole pieces of businesses.
For the premium you'd have to pay if you were buying the whole thing.
Yeah, so you get a bargain as an investor compared to what I can get in terms of buying the whole business. And people, if they just think of stocks as pieces of business, they'd be so much better off than thinking of them as little things that move around in price. And I think with Berkshire, we have an unusual number of people as shareholders who just look at Berkshire as a business. They look at it as a savings account. They put some money in 20 or 30 or 40 years ago. We retain it and reinvest for them, but we're their savings account. What is a stock? A stock is the same sort of thing. It has a bunch of coupons. It's just they haven't printed the numbers on them yet, and it's your job as an investor to print those numbers on. If those numbers say 10%, and most American businesses earn over 10% on tangible equity. If they say 10%, that bond is worth a hell of a lot more money than a bond that says 3% on it. But if that government bond goes to 10%, it changes the value of this equity bond that, in effect, you're buying. You are buying, when you buy an interest in General Motors or Berkshire Hathaway or anything, you are buying something that over time is going to return cash to you. Maybe a long time in terms of Berkshire, but it'll be bigger numbers. And those are the coupons, and it's up to you, your job as an investor, to decide what you think those coupons will be, because that's what you're buying, and you're buying the discounted value. And the higher the yardstick goes, and the yardstick is government bonds, the less attractive these other bonds look. And that's just fundamental economics.
Warren is a financial genius because he's one of the richest men. No investing list or forum can be complete without the mention of his name. It's not easy to be like Warren Buffett, but there are steps you can take to get to your own financial peak. I will leave you with a quote from Warren Buffett which goes like this: "Be fearful when others are greedy, and greedy when others are fearful." Don't forget to subscribe to Mr. Vin TV. See you again tomorrow.